My name is Fernando Levijara. I'm a developer of multifamily. When we teach real estate cycle, we say follow the people and follow the money.
Hi, everyone. My name is Branko Kuzmanovic. I'm a director of acquisitions at Imperial, really well-located properties, specifically for South Florida. If people had a really good capital stack figured out and they weren't really pressed to sell, they're just not really itching to sell at a really expanded cap rate.
My name is Jeff Arzam. I'm principal with the estate companies. I think it's ultimately a question of, are you chasing yield or are you chasing a core plus asset that is going to be great for you? You're not going to get the yield that you want. It's kind of like weighing them both out and trying to find a perfect scenario.
Everyone, David Moghavem. I'm head of acquisitions at Tryon Properties. I think now people know where the market is, of where some of these assets are trading at. Whether as in the beginning, when things blew up and there was uncertainty, there was a little bit more price discovery. It's so interesting because pre-rate hike, everything was solving to the same. Whether it was even value add, core plus, different markets, like everything was same cap rate. That completely reset when rates ran up, and you're starting to see all these different markets price at different cap rates depending on the risk, which is how it should be.
Thank you for staying. So my name is Fernando Levijara. I'm a developer of multifamily in the Gulf of America, formerly known Gulf of Mexico. But mainly I'm a professor in real estate cycles in Harvard University. So we deal all the time on trying to get the crystal ball of what will happen in the future. And one of the crystal ball things that we have all the time is what will happen with cap rates. So after this picture, let our speaker introduce themselves, so we start the ball rolling.
Hey everyone, David Moghavem. I'm head of acquisitions at Tryon Properties. We're a value add, vertically integrated company. We strictly buy multifamily in Florida, Georgia, Carolinas, Texas, Colorado, Oregon, and California. We have an office here in Miami, and we're headquartered in LA, about $1.5 billion AUM and over 7,000 units.
Hi, everyone. My name is Branko Kuzmanovic. I'm a director of acquisitions at Imperial Group. We're a multifamily development firm headquartered in Switzerland and Europe. We have offices here in Miami. Our strategy is to acquire the best located infill urban walkable sites for Class A multifamily development, anything mid-rise and high-rise. I have a few projects here and some in Dallas, Texas as well. So I'm happy to be here.
My name is Jeff Arzam. I'm principal with the estate companies. We are a completely vertically integrated real estate firm. We have about 5,000 units in the pipeline right now. Under pre-construction, entitled or stabilized, we build Class A product, traditionally more merchant build in nature, where we entitle land, develop the land. We're also the GCs on it, so self-perform most of our deals, stabilize the asset, and then sell to institutional funds or end buyers once the assets are stabilized, TCO. Sometimes we do have partners where we do some recap or take out deals, depending on the capital structure that we have. Most of our capital is friends and family, more local, and we focus strictly West Palm, Broward, and Dade County. Mid-rise, high-rise, garden deals, mixed-use projects.
Okay, so what do you think that the first question is, we know we have been listening a lot in the last panel that spread keep compressing, interest rates are still high, but for some reason in this last cycle, what we have learned in Real Estate 101, and we have been teaching for 25 years, is that when interest rates were going up, the cap rates were expanding. So the first question is, why did you think that this time that didn't happen?
Do you want me to go? You're ready. Let me see how to answer that question. It depends. It happened sometimes and sometimes it didn't happen. If you're asking if the spreads have not, generally when Treasury goes up and your spreads are not as wide as they are when your Treasury is a lot lower, right? We're basing sales based on a 10-year Treasury with a spread. If your Treasury is going up, you're tightening your spread. That's just the way it goes. That's just the general fundamentals of, when you're looking at just in general acquisitions. To be honest with you, there was just a lot of things happening in capital markets. The funds that had a lot of redemptions. People, I don't know if I want to get into the next conversation, but the buyer and sell spread with buyers and sellers it was still very wide. So I don't know. I think that's more a question for the guys that are actually buying our product, but it seems to me that it's a little bit all over the place because I saw spreads that were very thin last year in a couple of deals when it was the summer and we kind of saw a dip in the 10-year treasury and some folks took advantage of it. And then you ask other guys and they're buying at 5.75 or other guys are at 4.75. Like it's just all over the place right now.
Yeah, I think so. You have a lens from a development standpoint. And I felt like it trickled in later, right? But when you're buying value add existing product, you were really just seeing the movement and expansion in cap rates in real time. Sure. I think what was interesting is when rate hikes started, obviously there was a little bit of a pause, and there was a little bit of price discovery in 2023. You saw cap rates move BIP for BIP with where treasuries were going. And everyone was, the theme of 2023 was positive leverage or neutral leverage or negative leverage. And everyone was solving based on relativity to borrowing rates. And I think that was because it was really more capital stack distress that you were starting to see and not necessarily operational distress. People were still paying rent. Occupancy was still fine. Right. Then you saw that glut of supply that people were buying building in 2021, 2022 start to hit. And you started seeing a little bit of operational distress in 2024. That was, vacancy upticks, collection upticks, depending on the market, concessions. And so that's when, no matter what treasuries were moving at, there was still a little bit, it wasn't moving BIP for BIP anymore because now people were starting to factor in some of the operational distress. So I think that's kind of how you saw cap rates expand in the beginning, where it was a little bit more BIP for BIP with where treasuries were moving, to now where you have sale comps. You have a whole set of data for the past couple of years of where things were trading. So I think now people know where the market is of where some of these assets are trading at, whereas in the beginning, when things blew up and there was uncertainty, there was a little bit more price discovery.
Yeah, great point. In addition to that, on kind of Class A, really well-located properties, specifically for South Florida, if people had a really good capital stack figured out and they weren't really pressed to sell, they're just not really itching to sell at a really expanded cap rate. So they're just on some of the Class A stuff here in South Florida, we just haven't experienced enough trades where it would prove that the cap rates have expanded or not. So people are just perhaps taking properties to market, seeing that they're not hitting the price per unit or price that they're trying to achieve for their investors. And they're just saying, okay, these are great locations. We can't build this for what we're in it for. And we're just going to wait for a little bit longer to see what we're going to do with the property. But a lot of people are doing well in Class A properties in South Florida as well. So it just hasn't proven that cap rates are expanded or not.
Yeah. Yeah, I would agree. And also, there was a lot of capital that was raised to buy assets at well below replacement cost. And I think those guys are struggling to do deals right now because I think the sellers are not there yet. Most guys that delivered in the past 2 or 3 years built to a good number, right, relative to what rents increased at. And so what's happening is that most guys can hold, right? I built a middle-rise, $255,000 a door, Class A product. It was built and bought out 3 years ago, and it's been stabilized for 1 or 2 years. Like, why? I'm not in a hurry to sell. Now, there is going to be at some point an inflection point where guys do need to recycle capital. Developers need to get out of deals. I don't think we've seen that yet, but I think it's coming. And I think some developers are starting to see that they cannot go on to the next deal because, especially if you're like a family or friends, capital raising is not more institutional, but I think more now are starting to kind of research, should we go the more institutional route versus the traditional family or friends if we can't recycle capital, and it really just depends on the strength of the sponsor and the assets in itself. But I think there's been quite a little bit of a dislocation there, and honestly, it all just depends. Are you a core asset? Are you a suburban asset? Are you going to stretch a little bit more because you could see some potential rent growth or some value add opportunities? That's the biggest question. But I think ultimately on our end was always not necessarily get heads in beds, even though the capital, your construction loans went from 5% to 10%, right? And I think for the most part, and people don't understand, is we're not giving concessions because we're having an issue absorbing rentals. We're giving concessions because we need to get to 90% because debt went up and skyrocketed, and now we need to get out, right?
Yeah. So I guess, the first part of what you were saying is the ability for developers to hold. And I think the experienced ones, Fernando and Jeff, you guys have ways and an understanding of how to either get out of your loans, or maybe you've structured it where there's some sort of mini perm after, which I would love to hear more about. I think what we are seeing, the people that are trying to buy new construction below replacement costs, they're trying to look for maybe the merchant developers who built fairly good product, maybe not the best, maybe not the worst, but it's newer construction, but they're cap stack distress where they didn't plan for a mini perm, or they did go a little bit over their heels on some of the leverage where they have no choice but to sell. How have you guys been able to kind of navigate the takeout loan, and getting that lease up in order to get a takeout to hold a little better?
So generally, like we've on 3 of the deals that we've structured most recently where we had that pressure, we got it to like 80-85% of these few deals. One of them was at 20-30%, but the cost of capital was so high. But at that time, like a year ago, you didn't know if this was going to last another 3 to 4 years, and we were like, okay, let's go out and get a temporary bridge loan, 3-year term on it, and with 1 year guaranteed, and hope within the hopes that in the next 2-3 years we'll be able to trade out and not get long-term permanent financing on it. And always, we always talked about that, and for us was always, and in times like this, it's just you got to remain flexible. If I need to trade an asset and it makes sense, I need to have the flexibility where it's not going to cost me as much. So although it didn't mature, that construction loan didn't mature, it was time to get out because I needed a little bit of more time.
Yeah, more runway.
Yeah, more runway, exactly, to get out to market. So I don't know if that answers your question.
No, it does. And construction or value add, it's the same cap stack problem, because as on the value add side, everyone was buying bridge, which is just another form of construction for value add. And that also had an expiring date, and runway was the number one priority. If you can get runway from your loan, you're putting good money after good, rather than if you're doing a pay down and doing a loan mod, but you're only getting 1 year, that's good money after bad, because that runway is not going to save you when the time comes to sell or come up with a better stack.
100%.
So actually what we are saying is that the opportunity cost side, interest rate has not been demonstrated that have been so influential, because as I asked 2 weeks ago to a big fund manager, why you are investing in my project with a spread of 1.4 when you could be investing that money in treasuries and going to play golf, okay? And we will go back to the whys. But what we are saying, I'm sorry that I get to the academic part, is what Jeffrey is saying that is very interesting. Interest rate eventually will start having an effect in people that needs to get rid of an expensive construction loan. And we know that these last 3-4 years, we got more expensive construction loans that we can digest. And we may see starting next year or in 2 years that people that is terming out in these construction loans will need to get out. And this is, if interest rate doesn't go down, that we may start seeing the impact.
Yeah, but at the same time, supply has peaked somewhat here in South Florida, and I think you're going to be in a different environment when those guys have to refinance, whether it's temporary financing or not, whether treasuries are below 4 at that point, and then whether it makes sense to trade in assets. It was in the beginning, for the most part, was just like the developer just needed to be in a position where we need to make financial sense for ourselves, and not necessarily that the market was not providing that, that the end tenant, there was no absorption. We don't have that problem right now. Of course, there's a little bit of, and I think for the most part, since we didn't know when we were going to trade, it for us was like, okay, we have to, this is not the market where it was 2 to 3 years before that, where you were selling the dream, right? And you were negative leverage for the first 3 or 4 years. No, like now you have to prove rents. And for my guys and for our strategy, and I told them from the very beginning, is people are not underwriting the T3s like they were before. You can show absorption going up, but they want to know what you can rent at. So we always focused on the last 3 or 4 years is like kind of really maximizing rents to see where they need to be, because we knew that the end buyer was going to be less focused on trying to make the deal work, quote unquote, and guys getting very aggressive. So as a sponsor, we try to bring the value on that side of it. Maybe brought up the expenses a little bit, but that kind of flushes out on its own, especially once you're out of lease up. But that was kind of our indication where cap rates were going to go up. Okay, well, we have to prove these rents. Same time, trying to get the building to 90, 95, it was just a struggle. It was a time like, what's more important, and what was more important 2 months ago versus today was way different. We just so much volatility and uncertainty with these markets, and it was
You're delivering during other peak supply and
exactly.
I guess like one of the questions for the two developers here is also like, now you're seeing supply nationally fall off a cliff, right? Is this a good time to be contrarian and build? What are you solving to on like a yield on cost to really buy it?
I was gonna say hell yes, but I just say it right now.
Yeah.
If you can, so here's like, for us is we have a lot of scale, right? We have a lot of economies of scale. We're on GC as well, and so for our labor and when we pitch out, it's not necessarily that we're not the highest payers, right? We're not, but they know they're getting the next deal, and so I can bring down my cost.
Yeah.
Right. Maybe more in the tune of like 10-15% than your normal builder can, because I can really crunch numbers, especially with 5,000 units in the pipeline. So that allows me to really focus in on being more of the value play for most. I just don't. I don't. What I'm trying to figure out, and what we're trying to figure out, is where do we stand in the next year or two. But the supply that's online right now is getting absorbed really well, especially in South Florida, in Miami, and in Broward, and in West Palm. But I don't even know what to tell you where 6 months is going to be from now. Like, it's just so difficult to have an understanding. I don't know.
We also see that while there's so much supply, certain sub-markets have less supply than others, like Wynwood and Edgewater are so overwhelmed with the amount of deliveries and concessions of 2 months. I mean, some really are struggling with lease-up. Some are actually trying to get to that occupancy as quickly and deal with their loans. But certain markets are well-positioned. They're high barriers to entry. Land's expensive, like Coral Gables. Obviously, Coconut Grove is impossible to get anything. But Brickell, West Palm Beach, downtown, certain pockets are doing really well, and there's not that much supply. But on the yield on cost, it has to be in the 6.5s in order to attract your investors for development. In order to get anyone into it. I mean, unless it's a really amazing story and incredible location, it can be slightly lower, where you can prove that your exit cap rate is not going to be 5 plus, but it has to be in the 6s, and it has to be a really good story, like Jeff said.
Yeah, and it's going to put upward pressure on rents. I mean, when you're delivering, if you can get off the ground right now, and you can deliver an asset in 2 years, where supply, 70% of the starts did not happen.
Yeah,
most of those guys are selling sites and doing the live local and doing like those. They're not real. Like, I hate to say it like that, but it's not happening, right? Like, it's so. While supply is peaking out, if you can get off the ground right now and deliver a new product in 2 years, I think you're going to have, as a merchant builder for ourselves, you're going to have two scenarios. You're going to have one where you're going to start seeing a little bit more rent growth, right? Because the market supplied was able to absorb those units, and you're going to get into an expansionary phase, I think, on the rent side, and hopefully by that time, the inflation in rents have actually subsided. I do think if you can get off the ground now and build to a 6.5 to a 7, which is extremely difficult, if you can have that room for that spread in 2 years, you're going to be delivering at a time where there's not a lot of new product. Does that make sense?
It's kind of like, it makes sense in theory, qualitatively.
Right.
Quantitatively, when you're kind of putting pen to paper, you start underwriting the cost of capital. You start underwriting the yeah, the construction costs, and now you have tariffs, so now construction costs are even higher. So how do you get to that 6.5 with all that going on? Meanwhile, there's yields that are kind of expanding with where rates are at today, to buy new product, maybe at replacement cost, maybe below, a little below, depending on who you ask. Oh,
I think scale. You got to have, like, in order for bring pricing down, you got to have scale. You got to have economies of scale. If you don't right now, you're not building. Most banks are not, people before were doing, which was crazy, which was they were building to 5.5 yields. And I think those are the projects that are now going to be coming online.
yeah.
And I think those are the projects that are going to have a very hard time. And I think that's where you could possibly see some distress.
It's interesting. If you hit that 5.5, like there is new construction today that's trading 5.25.
Of course.
You know what I mean? So like it's not a home run, but like they'll be okay. They're not gonna like lose. They're not gonna get, their equity is not gonna get wiped. Maybe they'll lose a little bit of money. If they hit the 5.5, they'll be fine. If they didn't hit the 5.5, they might be a little bit in trouble.
But the problem was they hit 5.5 with construction costs at 6.
That's what I'm saying. If they actually hit that 5.5, like if they were on budget, they were on time, which like in construction,
they may be okay. Yeah.
very, very tough to do. So I don't know. Fernando, I guess like as the other developer, how are you guys like solving to now? And
one of the things that are happening and why the pipeline is drying up, because there are not too many projects that are working. And if they are, construction lenders probably are not lending. What Jeffrey was saying about 30%, 70% of the project not happening, actually, in the real numbers, this is what we see in our research. After 2 years of delivering almost 1 million new units, which was 2022 and 2023. Last year, the number already dropped down to 750. And if we see now the amount of units being built started in the last 30 days is less than 100. So supply is really going down very fast. It will depend on also in the regions. So I want to ask Branko and David a question that we cannot reply because we are a single market guys. He's in South Florida. I'm in the west part of Florida. So do you see differences between the different market where you are operating? Which one are the ones that you see more realistic and one more artificial?
Our firm is focused on South Florida and then Dallas in Texas. So we're lucky that both of those markets are pretty vibrant and exciting, and the fundamentals in both markets are great, with population trend, jobs, relocations of firms and decision makers. So somewhat similar fundamentals in both. There's been a little more, I feel like a little more development in Dallas, depends on where you are, but definitely the suburban parts of Dallas, there's been so much and so many deliveries. But overall, we're excited. I mean, when you go to Dallas as well as in here, people are looking for deals. They want to make things work. They want, the capital is there versus any of the other kind of historic gateway markets like Chicago or San Francisco or something like that. So both the dynamics in both markets are really good, and people are trying to make numbers work and trying to get projects off the ground.
Yeah, I would say, we're in a bunch of different states: Florida, Georgia, Carolinas, Texas, Oregon, California, Colorado. So we have a pretty good lens on kind of where cap rates were and how they've moved and shifted. It's so interesting because pre-rate hike, everything was solving to the same, whether it was even value add, core plus, different markets, like everything was same cap rate. No one was really even looking at the cap rate. They're all solving to maybe some return on cost. That completely reset when rates ran up. And you're starting to see all these different markets price at different cap rates depending on the risk, which is how it should be. So you look at the Carolinas, Raleigh, Durham. This is like the sexy market right now that people want to invest in and has good collections, good. Everything is super tight cap rates, are you getting a risk adjusted return, and is that risk justified? And what I'm finding right now, at least at Tryon, the sentiment is we really like out of favor markets. So we bought a deal in Atlanta in October. We have another one under contract. A lot of people are kind of saying Atlanta's out of favor, justifiably so. but you're getting some incredible yield, positive leverage day one for quality institutional assets. And what you're also finding is the headline risk for some of these markets are a little bit over amplified. And we're seeing some of these struggles operationally that may have hidden out of favor markets start to trickle into the favorable markets. So by having boots on the ground, you kind of see how these dynamics shift. South Florida, similar issue where it's a sexy market. We're all in Miami for a reason. It's amazing here, but you're seeing delinquencies start to trickle up. You're seeing the supply start to hurt some of the operations. Insurance, really hit the past couple of years. It's starting to stabilize and come down. So it's priced accordingly, right? So now it's a good time to take a step back and saying, is the risk adjusted return make sense on these deals?
Yeah, and I also think it has to do with there's some discovery on cap rates too, right? Which takes time. A year ago, we had no idea where they were panning out. And I think it's ultimately a question of, are you chasing yield or are you chasing a core plus asset that, is going to be great for you? You're not going to get the yield that you want, but it's kind of like weighing them both out and trying to find a perfect scenario. But, like in South Florida, long-term fundamentals, you can't go wrong, right? And what's happening with the growth of this city, the regulatory environment is pretty much non-existent here. And you have other metro areas in the United States that do have those issues. New York, Chicago, there's Washington, there's places where capital is no longer being a place that people may want to invest, too much time in. And we saw a lot of that capital, the flight, come over here. And now we're trying to realize how much of it is actually going to stay. So I can tell you one thing. The renter in Miami, in South Florida, in Broward, the demographics have doubled. Household incomes have doubled in our buildings, and not necessarily because we got guys who are getting high salaries and relocating down here, because that is happening, by the way. But it's those people that they cannot consolidate. You can't buy a home. You're coming out of college making $100,000 a year, and you get married and you have a household income of $150,000 a year. You can't find a home to live in.
Yeah,
you can't. The only thing you're going to do is that you got to go live vertical. And so we're starting to see those type of consolidations happening in our rental buildings. And while what used to be 140,000 household income, now it's 250 average. In our Aventura project is 250 average. And you're averaging $3,500 rents. Now we'll see when it's adjusted for the inflation, it's kind of seeing where we're at that point. But you kind of want to be in those markets, I would assume, that have, when you talk about risk adjusted returns, we want to be in markets that, although I'm getting a lower cap rate, I know that my money's somewhat kind of safe, right? Not safe in a sense, but it's appreciating with a long-term vision. So I guess it's really what you're looking for when you guys, and question for you guys is are you looking to sell 5-7 years? Your investment strategy, is it more long-term in nature, or is it very flexible?
It's a good question. We're generally 3 to 5 year holds. So our outlook is definitely more of a 3 to 5 year hold outlook. We have partners that have 10 to 15 year holds, and their perspective is very different. For instance, they won't invest in Florida because of natural insurance risk, and
Sure.
and they miss out on the boom, right? But they're also thinking long term about the insurability of Florida, so whereas for us, we're kind of on the same boat where we're there's so much amazing stuff happening here, and if you could pencil insurance costs today in Miami and you diversify that insurance risk by having a master insurance policy and stabilize it, you'll get paid when kind of some of that insurance starts to come down and stabilize. So by 3 to 5 year holds, you're just assessing different types of risk.
Sure.
Whereas we probably wouldn't be as bullish on a market with political risk, right? Like a LA, or which I'm from. And I moved here, so I'm one of the data points. So that's tougher for a group like us raising capital to underwrite that risk.
All of our capital is European pension funds and insurance companies, so it's a much longer term hold. And that's kind of what David said. We feel that if we pick the right locations here over that kind of 3 to 7 year period, you will get lucky, quote unquote, and you will exit the investment at the right time where insurance stabilizes, cap rates come back. And that's why we love it here. We think this is long term. This will be the ideal. We've always kind of tried to expand into other markets, but as Jeff said, why go somewhere else where there's so much to do in South Florida? So many markets that are continuing to do better. There's scarcity of land and then just so many infill opportunities where
100%.
developments will do really well.
Yeah, like all the characteristics and the fundamentals you look for, they really check the box, right? Like you always have your insurance, and that's kind of subsiding right now. Those guys that on the road insurance at higher, $2,200, $2,300, and now you can get it, 15, 16, 1,700, depending what the asset class is and where you're at. They're looking at, we're doing well, but then they got hit with something else. Like it's always something. It's never.
I always say if Miami didn't have the insurance risk, the cap rates would be trading tighter than like Raleigh or some of these other places that are that are sub 5 caps even for core plus deals.
Oh, yeah.
So the insurance has kind of played a little bit of a role where you're actually getting a little bit of a expansion in cap rate. But it's still Miami. You still have foreign capital coming here. It's from coming out of COVID. It's now a standalone market. It's transformed larger than any other city I've seen coming out of COVID.
And what are you guys underwriting? Sorry if I'm asking these questions for them because
No. I love.
What is your?
I love a moderator that doesn't need.
Yeah.
Your job's easy.
In general, what's when you're underwriting a transaction and buying a site or buying a project. What are you really looking in terminal value? Like when you underwrite a deal today, let's say in South Florida, what is your terminal exit value? Like what cap rates are you guys using? I know that's
It's definitely
like a crazy question, but you're doing it. So
yeah,
I would really like to know that.
No, I mean, I think what we conceptually try to, use as a North Star is you have a whole set of comps at peak of where things were trading from a price per pound basis. Obviously, the cap rates were insane. I don't think we'll get back to those cap rates. But I think those price per pounds at least give you a little bit of a reference point that if you buy a deal today and you're trending rents and you're putting an exit cap and it's in line with where things exited at peak, our take at least is that we'll get back to that price per pound in the next 3 to 5 years.
Okay.
So if we're past that, if we put an exit cap and we trend rents and our exit price per pound is higher than kind of where comps were, it's like, all right, that's a little bit too stratosphere. We're a little over our heels. Let's at least try to not break records. So that's kind of like our North Star. I'm curious to hear what you think.
The challenge that we have is just on the mid-rise and high-rise product. We haven't had enough transactions in the last year or two. As the rents have gone up, simultaneously the exit price per unit will go up as well. But we just haven't had that many, like in Brickell and downtown and Coral Gables, that are kind of allowing you to underwrite these deals with an exit price that's, I don't know, $500,000-$600,000 a door on a brand new construction. So that's what it costs you. You get the bids, it's expensive, you're getting really high rents, mid-4s. Your exit has to be, I don't know, $500,000, $600,000 a door in a really good location, but you just don't have the comps to prove that because nothing's transacted. So that's something that we're continuously struggling with and adjusting underwriting and saying no to projects because we just don't want to be the ones that are underwriting at crazy numbers that we don't feel comfortable going forward with. So I think that for all of us that are developing brand new product, it would be awesome for some of the properties that have high rents to transact to kind of give us that feeling where we can comp it out to that because our firm just doesn't believe that you can buy a Class A product in a great location significantly below replacement cost in this market. Let's say it's like a downtown.
Especially when all the money is going to that market and with demographic, right?
Yeah.
When we teach real estate cycle, we say follow the people and follow the money. So if the money is going to a market and the people keeps coming, so my question that we have just 2 minutes, what do you think that will happen if in a year or two interest rate went down 1 point?
A lot.
If we have this high cap rate with this short gap, with this interest rate, what may happen in that case? And we have 1 minute 43. Clyde.
10-second. In September of 2024, treasuries hit mid-3s and the market was ripping.
Yeah.
Like you just saw the BOVs and things were, so like, I think
it was just like,
yeah.
oh,
Yeah. And now we're 50 bips higher than that today. I think the 5 years at 4% right now. So I think we already got a glimpse of like what's going to happen just from 50 bips.
100%. Yeah.
I don't even think we need the full 2.
And we are developers. That's why
Yeah,
we are
no,
optimistic,
that's,
right?
no, and we saw it even in the summer when it dipped, and we saw a few transactions happen. Then guys who closed, and listen, the guys who are going to win, a lot of guys that are going to win are guys that also can go in and buy cash and don't have and can do like a quick close. There's not as many of those guys that are out there, but for right now, if rates are not at where they need to be, those are the guys that are getting a little bit more competitive. But I agree with you. I think the floodgates open below a 4. 100%.
Yeah.
They open up.
Yeah.
And it'll be interesting to see what buyers open up too, like down here, like who's going to be out on the market for sure.
Okay, so thank you very much, everybody that stayed until the end. Thank you very much, these great speakers, and see you next year.